Morning. It is September 25th, and welcome to the first of a 6-week webinar series sponsored by Freedom Care Benefits. Today's topic is how an employer can guarantee ACA compliance, 3 easy steps. And I am your presenter today, Kaya Bromley. I am the president and founder of Your Obamacare Advisors. I'm also the author of the book, The Employer's Guide to Obamacare: What Profitable Business Owners Know About the Affordable Care Act. You can visit me or find that book on Amazon or at yourobamacareadvisors.com. Today with me co-presenting, I have Ryan Moulder. Ryan is with the healthcare attorneys in Los Angeles, California, and he also works with Your Obamacare Advisors to assist employers and brokers getting ready for the Affordable Care Act. Hi, Ryan. Thanks for joining us today.
Good morning. How you doing?
Great, great. So without further ado, we are going to get into this webinar, but we want to first give because Ryan and I are both lawyers, we have to give a sort of pseudo-legal warning. This webinar, although we are giving our legal opinions, this is not legal advice. The ACA is so individual, and every business owner needs to really look at their own business, and some of the advice that we're giving is very broad. So this is not a substitute for hiring your own legal counsel or team to come and help you look at the ACA. That said, it's also not a reason to delay planning. The things that we're going to tell you are some great ideas, but they're only as good as if you do something about it, and you need to do something about it well before January 1st. You can't wait until the end of the year. You need to be planning now. And finally, this isn't a reason to panic. On the one hand, we're going to tell you some really scary things, and we want you to panic a little bit because we think that, at least I'm seeing, and I know Ryan's seeing, a lot of our clients are not panicking enough. They're not getting ready. They're not doing anything, and they think that things are just going to work out. And that's just not true this time, and we'll talk a little bit more about that. But before we get into it, one of the things Ryan and I talk about a lot is there's so many people who are just panicked and thinking that they're going to be literally screwed by Obamacare. And Ryan, I know you're helping a lot of your clients. So real quickly, can you give us an idea of, there is time to plan. What are your thoughts about people who are not planning and the time to plan is now?
Right, I agree. I mean, we're getting pretty close to the deadline where it's going to be hard to help clients that come to us in late November and December saying we haven't done anything. So if you're an employer that hasn't done anything, you really need to start planning for this now, because it doesn't appear there's going to be any more delays, and the government's going to need to collect the fees that are in this act just to fund the bill.
Yeah, that brings me to the next slide, which when I'm speaking to large groups, I often bring up the point that this has been kind of like a video game, where in video games you get extra lives and you get to keep going and keep going. All of the transition and relief and all the delays that have happened have given people, I think, a sense of calm that they're going to keep getting more time. And the message that I'm giving people that I talk to is that there really is no time. There's no more extra lives. Your time's up. And it was funny. I was talking to not funny, actually. It was kind of scary. I was talking to a broker recently who said that he's not really worried about it because he thinks everyone's on top of it. Everyone has their own attorneys. And I said it's sort of like, if you saw your neighbor's house burning down and you knew that he was asleep inside, wouldn't you go try to wake him up? We as attorneys and insurance brokers and CPAs who are watching this happen and who understand how serious these penalties are, it's very nerve-wracking to us to see people, to see the news is not covering it, and see people just, really calm and waiting to see what's going to happen. And I don't know about you, Ryan, but I know that it's going to be far worse than anybody thinks it's going to be.
Well, I agree, and I think that's when the news will start covering it again, is when employers start getting hit with penalties. And unfortunately, then it will be too late for employers to correct anything that had happened in the past as far as the penalties that they're being assessed.
And unfortunately, this is, a lot of the people that we work with are entrepreneurs. And entrepreneurs, one of the things that make entrepreneurs great is that they kind of just jump and see where they land, and they figure someone's going to clean it up later. And it's a beautiful thing about entrepreneurs. It's why they take risks. This, unfortunately, is not one of those times. And this is one of those times that just saying I tried or just hoping that it's going to work out, the IRS is going to make an example of somebody. And as my advice to people is, don't let it be you. So let's go into now what are our 3 steps for guaranteed compliance. So we're going to give a little bit of background here, but we're not going to go into a ton of background. If you don't understand what these penalties are, we recommend strongly that you go buy my book at yourobamacareadvisors.com and get acclimated with these. We're going to go through all of this as if you already are familiar with these penalties. So step 1 is avoid penalty A at all costs. This is going to surprise people because they think that there is a lot more to the overall compliance, but the number 1 way to get through the ACA is avoiding penalty A at all costs. So Ryan, I'm going to let you go through, explain how is penalty A triggered?
So penalty A is triggered if, for 2015, there's transition relief that says you only have to cover 70% of your full-time employees. So if you're not covering 70% of your full-time employees and just a single full-time employee receives a premium tax credit from an exchange, that will trigger what we're deeming the A penalty.
So go ahead.
Sorry, I was just saying in future years, beginning in 2016, instead of covering 70% of your workforce, you're going to need to cover 95% of your full-time employees, not 70%.
And so to get into kind of the details of why penalty A will suck, this is an extremely brutal penalty that a lot of employers that we work with are very brazen about and very brave. They think that they're going to be able to avoid this. And so, for example, for a minute, I'm going to give you some examples of why how bad it can be. So if you think about it, if you've got if you're being penalized $2,000 times every full-time employee, now you get to deduct the first 80 in 2015. But it's triggered even for employees that you're offering coverage to. So it's almost like a strict liability. One person goes to the exchange and you pay this penalty for everybody. The reason that it's really going to suck is because a lot of people believe that they're doing things properly. They believe that they have counted their employees correctly. Ryan and I together are working with one client who thought they had counted their employees correctly, thought they counted the hours, and found out later that they didn't. So they originally thought they were going to have about 200 part-time employees, and now they have more like 500. That's an example of a time when they didn't anticipate at all that they were going to even be subject to this penalty. And not only are they going to be subject to it, they're going to pay $2,000 times 500 minus the first 80. There's a lot of nuances in the law too, where people might think that they've got it down, but then they weren't familiar with the little subtleties. So for example, and I'm just going to give a couple of them, and Ryan, I know you've got some of them too, but let's say that you have a non-calendar year plan and you don't understand all of the rules that allow you to be qualified. If you miss that by one day and you don't offer your insurance on the right day, you could trigger this penalty from, let's say your non-calendar year plan starts in June. If you don't do it right, you could trigger this penalty from January to June. Another thing is if you screw up the 90-day waiting period, you may think that you're on top of it. And if you screw that one up, you could pay the penalty from that whole 90 days or up to 4 months. Another thing is offering. So one of the biggest mistakes that I see, I've seen a lot of franchisees use as a strategy that they are not going to bother offering insurance to anybody who is on Medicaid or getting spousal coverage, because those people aren't going to go to the exchange anyway, right? The problem with that strategy is you still have to offer them coverage. And these are the things that people think that they're being tricky and they're, really thinking things through. But there's more ways than you think that this penalty will be triggered. And not only that, that often this penalty is going to be more expensive than simply complying with the law. Your thoughts, Ryan? Anything to add on that?
No, I completely agree with what you're saying. And I think the most important word here on this slide is all. The penalty for A applies to all full-time employees. It does not matter if they're on Medicaid, Medicare, if they're on a spouse's plan. It applies to all full-time employees. So when you're calculating the A penalty, you need to keep in mind that it applies to all full-time employees, even if they're being offered coverage. And that if you think of that, the worst case scenario is you're offering maybe 65% of your full-time employees coverage in 2015, and the other 35% of the full-time employees are not being offered coverage. You're going to have to cover the expenses for the 65%, their healthcare expenses and the compliance with the ACA. But in addition to that, you would have to pay a penalty for 100% of your full-time employees.
Yep, it's pretty brutal. Let's look at an example. For example, if you had 200 employees and you got assessed this $2,000 penalty, you could subtract the first 80, which means you're calculating it based on 120 employees. Your penalty A exposure would be $240,000. And as Ryan just pointed out, let's say you were actually offering insurance to 100 of that 120. You still have that cost, and you probably already paid that cost because you're not going to find out that you were assessed the penalty till later. So your penalty exposure is $240,000 on after-tax income. So it's not even, so if you offered insurance, that would be tax deductible. Obviously, the insurance is not, or the penalty is not. And so it's far more than even the $2,000 per employee penalty. So it's a brutal penalty. So let's go into our concept of how do you avoid penalty A. You offer minimum essential coverage. It seems really easy, but there's a little bit more complication to it and a little bit more nuance. So Ryan and I are going to go into the details of this extremely important strategy that we think is just simply step one to being ACA compliant. So we call it the MEC strategy. The purpose of the MEC strategy is to limit exposure to penalties, period. MEC stands for minimum essential coverage. Ryan, can you talk a little bit about what is minimum essential coverage as defined by the ACA?
So minimum essential coverage can really be as simple as just offering the required preventive health services that the Affordable Care Act requires. And this is what's commonly referred to as a skinny plan strategy, which became pretty popular a few years ago when the Wall Street Journal made light of this being compliant with the Affordable Care Act. So they gained in popularity just because of the Wall Street Journal's a very well-read publication, and attorneys that have looked into the matter since then have determined that these are legal, and the IRS and Treasury has actually come out to say they're legal as well. And essentially the skinny plan is going to offer the bare minimum required to be deemed minimum essential coverage, and that is just going to be the preventive health services which are required to be covered by the Affordable Care Act.
And the important thing that if I could get anything across to anybody listening to this webinar today, is that many companies are using this strategy as their own insurance policy to limit their exposure to the A penalty. There are a lot of companies across the country who are offering a skinny plan to all of their employees, all of them, even variable hour. The reason for that is because of the first example that I told you early on in the webinar, where we saw a client who thought they counted their employees correctly and got the count wrong. So an extra almost 300 of their variable hour employees were actually full-time. So they're using this as an insurance policy because you can get one of these MEC skinny plans for about $100 per employee. And I'm sure there's other price ranges. I just happen to know about a couple, $100 per employee per month. So it's not even to me, this is just where you start. I don't even think that you play around with the A penalty. Would you agree with that, Ryan?
Oh, I definitely agree that offering a skinny plan is at least a good starting point as far as strategy goes for almost any employer. I guess in the rare situation where you're just over the threshold of being an applicable large employer, it might not make sense, but for the vast majority of employees, offering some sort of skinny plan is going to make the most sense at a minimum.
The other reason why this is a really important strategy is because when the employee has this skinny plan, they're not subject to the individual penalty. And we'll talk a little bit, I'm going to do a little sidebar right here. If for employers that are just offering a bronze plan or offering something that the employee could walk away from, if the employee walks away from those plans, they can't get a subsidy on the exchange, and they have no insurance. So it costs them money to actually work for you at that point because they've got to go and pay the penalty for not having coverage. So the other benefit of the skinny plan is it does satisfy the individual's requirement to have health insurance.
Yeah, I think that's a great point, Kaya, that the skinny plan, if accepted by the employees, does satisfy the employee's obligation to have some sort of coverage.
Yes. So let's go on to step 2. So as I said before, the skinny plan strategy or the MEC strategy only handles the A penalty. There's also the B penalty, and step 2 of this is obviously avoid penalty B at all costs. So Ryan, why don't you explain to us a little bit about what is penalty B?
So penalty B applies if the minimum essential coverage offered by the employer is deemed to not be affordable or does not provide minimum value. And it applies for each employee that receives a premium tax credit on the exchange. So there are really actually 3 ways that this penalty can be triggered. The first is the coverage is not affordable. And affordability is defined under the Affordable Care Act to mean the coverage cannot be, or the participant cannot pay more than 9.5% of the individual's household income. And the final regulations actually provide 3 safe harbors for employers to follow. One that's based on the W-2, another that's based on rate of pay, and the third that's based on the federal poverty line. And it's this way because an employer is going to have no way of knowing an individual's household income because it can be impacted by other jobs, spouse's income, another dependent's income. So if you meet one of these safe harbors, your coverage is going to be deemed affordable for that employee. And the second requirement that must be met is it must provide minimum value. And minimum value is essentially the plan share of the total cost of the benefits provided under the plan must be at least 60%. So that's essentially a bronze plan, which I'm sure a lot of you are familiar with. So to meet minimum value, if you're offering a bronze plan, you're going to satisfy that requirement.
So to break this down a little bit, so you can offer a skinny plan, but if you don't also offer something that is minimum value, you could be subject to the B penalty. The B penalty is $3,000 times the total number of full-time employees who qualify for a tax credit or subsidy. So unlike the A penalty, where it only takes one employee going to the exchange and you pay the penalty for everybody, this one, you pay the penalty for each employee who goes to the exchange. Now, I've actually sat in on presentations where some programs use this as a strategy that they say, well, you can count on not many of your employees going to the exchange because they don't want to spend anything out of pocket. They never got insurance before, and they're just not likely to. Ryan and I believe that this is absolutely absurd. So let me tell you a couple reasons why. The first is that the feds are actively recruiting your employees to the exchanges. The reason is they need a lot of young, healthy people in the exchanges so that they can have larger risk pools. Otherwise, they risk only having the sick people on the exchanges, and then the insurance is too expensive. So you can plan on the feds actively trying to get your employees into the exchanges. The second reason is that the subsidies and the tax credits are far more favorable for employees than anyone thinks. And Ryan, I know you've had some experience with this with some people you've worked with. So why don't you explain a little bit about that?
Yeah. So I think just to clarify, the skinny plan does not meet the minimum value requirement. So that's the reason this B penalty is a problem. And I actually have a model that calculates what an individual, depending on their zip code, will have to pay after they receive a premium tax credit, which if you're only offering a skinny plan, the employee will still be eligible for. And in a lot of states and zip codes that I've looked at, the employee can actually get the cheapest bronze plan for free if they're making anywhere from $10 to $12 an hour, which, I mean, if you can get something for free, I don't know why an employee would not take it. So it might take a while for the market to become efficient, but when these employees understand that they can get a bronze plan for free, I don't see any reason why they would not accept it, because it's going to be better coverage than their skinny plan that they're being offered by the employer.
Yes, and not only that, the subsidies and the tax credits are available for people making up to 400% of the federal poverty level, which for a family of four, I believe it's something like $92,000. I mean, this is a very generous assistance package that's available. The other problem with Penalty B, I think probably the biggest problem with Penalty B, is that you're often not going to know about it until it's too late. So the IRS themselves has said that it's going to take them probably 18 months before they get to auditing on these things. The reason is because they've got to wait till the exchange reports back, the individual files their tax returns, and the company files their tax returns. So often you could be in violation of this penalty for as many as 18 months. And by the way, if the IRS is saying 18 months, probably more like 24 plus months. So you're in violation for a really long time before you even realize it. So the better strategy to guarantee compliance is to make sure ahead of time that you are not going to trigger this penalty, either of these penalties. So let's get into now how is penalty be avoided. So let me state the obvious. You offer an affordable minimum value coverage plan to all of your employees. Of course, that's not it. We're going to talk a little bit now about the details of what's behind the minimum value strategy. So
okay, can I just jump in?
Please.
Just jump in here and just clarify one thing that some of our clients have come across. So say you are offering only coverage to 70% of your full-time employees and you're not offering to the other 30% of your employees, full-time employees for 2015, that is a compliance strategy for the A penalty. But the 30% of the full-time employees that you're not offering coverage to in 2015, they can trigger the B penalty. And I think that's something that has kind of gone under the radar for certain employers. And I just want to be perfectly clear that the B penalty can be triggered by any employee that's not offered coverage.
That's a great point. So one of the strategies that we see is sometimes people call it a walkaway plan. This would be, let's say, an employer offers just a bronze plan with high copays and deductibles, high out-of-pockets, and they just anticipate that most of their minimum wage employees or lower wage workforce is just going to walk away. They're not going to take the coverage. In a perfect world, I guess, that strategy could work. It does leave the employee exposed to the individual penalty. However, the problem with that is finding an insurance company that would agree to it. Now, there are limitations on minimum participation rules by insurance companies. They're not allowed to do it in the way that they used to. However, there's no limitation on an insurance company raising the rates to make up for the number of people that enrolled in insurance. And the reason that they would do this is, I touched on it a bit earlier, is this idea of adverse selection. If you have 10,000 employees and only 10 sign up for the insurance, guess which 10 sign up? The sick ones that are going to use the insurance. And the way that insurance works is they require a pool of people who are sick and who are well in order to make the cost of the insurance make sense. So even if insurance companies, aren't allowed to just deny the coverage, deny the policy, they're going to get the same result of making sure that they can be a profitable business. So that's the concern that we have with the walkaway plan. And I encourage you, if you are doing something that you think is a walkaway plan, have an attorney that's familiar with the ACA and familiar with employee benefits look over that contract, because more times than you can imagine, someone shows me the contract after they've signed it, and there was in fact some type of clause that requires them to pay the difference, or some other way to get them to raise the rate or something that left the employer in a very bad position. So the other thing too is, let's say you have a strategy of offering a bronze plan, but you have lots of employees accept it and know that dollar sign's not a typo. Because you may think that everyone's going to walk away, but you've offered this insurance and a lot of people took it, and it's far more than you can afford from your business. So one of the ways that we encourage our clients to deal with this is, I say hedging, is if you also offer a minimum essential coverage plan in addition to the bronze plan, there's going to be some lower wage workers who are happy with the MEC plan, and they got some coverage, and so they're not going to take the costlier plan that's going to cost you more money. So offering the two together is actually the ideal way to deal with this A and B penalty. And Ryan, do you want to talk a little bit about what it means to offer the insurance?
Sure. Okay, that's actually one of the things the final regulation doesn't really expand upon too much, but there are some things we know about it, and that is it's an offer of coverage. The employee does not actually need to accept the coverage for the employer to satisfy its ACA obligations. And I guess another important thing to point out as far as just the offer being timely. In other words, you can't offer coverage on December 31st for coverage to begin January 1st. You're going to have to give the employee a reasonable time to either reject or accept the offer. And when you're making this offer, you want it to be really clear and have good documentation that you made an offer and that the offer was rejected, if it is in fact rejected.
And that's also one of the reasons why we're telling our clients that your time is run out. You have to be doing this now. You can't wait until October, November. In fact, all my clients, I'm telling you, have to have this done before November 15th. Because the worst thing that you could possibly do is allow all of your employees to go give conflicting information to the exchanges. The exchanges open on November 15th. So having your offer of coverage done before that is just one more place where you can protect yourself in the event, of an audit down the road, or in the event that your employees go to the exchanges and say you didn't offer coverage. The fact that you offered it before November 15th really does cover your butt. So the offer is a pretty significant piece of this. So I want to talk a little bit about one thing that there was a Washington Post article just last week that was saying, there was a quote by someone that said that employers who offer this really need to check their conscience. So I want to talk a little bit about this, because there's a shift in the way that we offer insurance, and it's taking some people to get their heads around it. But the argument that this is somehow mean-spirited, or that you don't have a conscience if you offer this, is honestly ludicrous to me. The ACA requires employers to comply with the law, period. It doesn't mean that if the law says that you have to do A and B, basically to have a conscience argument says that you're awful if you only do A and B. You really should do A, B, C, and D. The fact of the matter is, this type of strategy it has been contemplated. The legislators and the regulators are aware of this, and they are not overturning it, which means that they are okay with this strategy, and if they're not, they're going to change it at some point. So there are going to be a lot of employers out there who are implementing these strategies. And if you don't, because you think that you have some kind of moral obligation to offer better insurance to your employees, you're going to be at a competitive disadvantage to the employers that are implementing this strategy. So arguably, some could say that it was the intent of the law to allow business owners to do this. And I'm careful not to give too much commentary of my thought about the law, but there's a lot of factors that the law did not address, like the cost of different types of healthcare, why insurance is so expensive. And it didn't address a lot of those things. It did to some extent, but instead it just shifted the burden on employers to provide insurance in the same structure that is not changed. So if you really want to look at what needs to be changed, there's something that probably needs to be changed by Congress. But the way that I would advocate to any employer is to comply with this law in the way that allows you to still be profitable, allows you to keep your business, and allows you to follow the letter of the law, period. That's my position on that. And Ryan, I know that's my soapbox. That one gets me pretty heated. What are your thoughts on this have a conscience argument?
No, I completely agree with what you're saying, is that the strategies we've talked about in this presentation are allowed by the law. And we've actually seen other areas of the Affordable Care Act where Congress has stepped in and amended the law. So until they do that on any skinny plan type strategy, they're almost giving their endorsement to this strategy. And like I said earlier in the presentation, the IRS and Treasury have said that the skinny plan strategy is a valid strategy.
Yep, I agree with that. So going along with, this is a problem that Congress needs to fix. If they want to make sure that employees have access to more quality health care, it's something that Congress needs to fix. It needs to be fixed at the insurance company level. The employers definitely, unless they had a conscience about this before the ACA was passed and they, were advocating for better insurance for all their employees, which, personally I advocate for. But I do not think that it makes sense for the employers to be bearing all of this burden and putting themselves at a competitive disadvantage compared to the employers who are going to implement these strategies. That said, step 3 is about documentation. I would say probably, Ryan, you and I both spend 90% of our time with clients talking about documentation. And we're going to go through some of these at a very high level about why you document. The biggest one, obviously, is audit. And we're not just talking about IRS audits. This law, it goes hand in hand with other laws that are already existing. It goes hand in hand with ERISA, labor. There's different departments that have their hands in this, the Department of Labor, the Department of Health and Human Services. And there are requirements that all of them had even before the ACA, but they didn't used to audit on it very frequently. And now they are taking this as an opportunity to audit on everything. And as anyone who has ever been in an audit before, or as a client that has been in an audit, if you have every T crossed and I dotted, your audit is usually not that painful. However, if the auditor comes into your place of business and sees that you basically thumbed your nose at the ACA and didn't really do much, that gives them a free ticket to get into your other business. And the IRS agents can't help themselves, because this not only shows that their value, it's also how they're planning to fund the law, is through penalties from employers. So these audits are no joke, and this is one of those places where, yeah, we do want to put the fear of God into you, because a little bit of planning right now is going to make your life so much easier down the road. And for anyone who thinks that audits are not going to happen, they're really living in an alternate universe right now. The other one too, and Ryan, I know you and I have talked a lot about this, is the ERISA lawsuits. We both have friends who are litigators who are just waiting in the wings to file some of these lawsuits. And even sometimes when I'm talking to my clients, I think, wow, this would be a great lawsuit for a ERISA attorney. And these are going to happen. because they're testing the law. This law is basically like a blank piece of paper, where we're interpreting it as we go. We're guessing what a court would do, because there's some provisions that very literally could be read two different ways, and we're guessing which one is the right way. So there's going to be losses. Ryan, what are your thoughts also about these last 3 points on documentation and why you should document?
Well, I think the points you made above are really important, just about having information you can provide the auditors, because once the auditor does find one thing wrong, like you said, that makes your audit a whole lot worse. And as far as the other points you're making on this slide, I think just having tax records to show, for instance, that you offered coverage is going to be critical. I think it was a pretty embarrassing situation that the government went through originally, that their software did not work properly. So I wouldn't put too much confidence in the government being able to realize that you offered affordable coverage for 2 employees. So I would have sound documents in case there are glitches in the software, and you can point to, oh, here's the offer I made, and you can say, here, it's affordable. So the clearer and more concise you can be with your documentation, the better off you're going to be. And I think another thing that will be important on any audit, or really any investigation, would be just a good faith effort of compliance, just showing that you actually went out and hired professionals to try to help you with your ACA compliance. Will go a long way in maybe having the regulators take it easy on you if you do in fact have some problems with any ACA issue.
You know, the other thing too, I know I touched on it a little bit, but with regard to the timing, you know, the fact that the IRS isn't going to get to these audits for sometimes years after the fact. I've got one client who told me that he keeps all of his records in banker's boxes. That's going to be a brutal audit. Now, I'm helping him to get everything done electronically and store things on a cloud system so he can access his documents easily, so he's one who will be saved. But if this is you, I'm telling you that that's going to be really a rough situation. And this evidence of good faith effort, the other reason why this is really significant is with regard to the $100 per employee per day penalty. There is a caveat in some of the discussions about this, that if you can prove that you really attempted to comply, but there was just some oversight or something, then the myriad of items that can trigger that $100 per employee per day penalty, you might be making a case for yourself to avoid that penalty. But if you've got nothing in writing, then it's your word against theirs, and you're very exposed to that. Now, $100 per employee per day, we did some calculations on that for one of our clients, and we figured out he would have been had to pay $8 million in 1 year if he triggered that penalty and didn't find out about it for a year. I mean, that's serious stuff. So this documentation is not something to be taken lightly. The other point that I would make is that whether or not you think you're documenting, you're documenting. So this is an actual picture that I took at the Oakland airport from the California Pizza Kitchen. So this is their documentation of one of the things that they're doing. I recently had someone show me a text message from his daughter works at a fast food restaurant, and his daughter's boss sent her a text message saying, we're cutting your hours because of healthcare. That's documentation. And if that girl ever sends that text to a lawyer, that's going to be evidence in court. So you're documenting whether you think you are or not. Let's make sure that you're documenting properly. So here's just this is a short list of things that you should be documenting, but there's many, many more. We just wanted to catch the highlights. Ryan, why don't you take the first list and I'll take the second list?
Sure. I just want to clarify one thing about the $100 per day per participant penalty. If your non-compliance with anything that triggers that penalty is unintentional, then the penalty can be capped at $500,000. But you're going to need to show that that it was unintentional. So documentation can really save you lots of money. And then the $100 is the maximum, so they can even take it lighter on you if they choose to.
Yeah, great point. Thank you.
And as far as what you should be documenting, payroll records, and these are actually going to be required for the 6055 and the 6056 reporting obligations. So you're going to need to know hours worked, but it's also one of the things I'm seeing here is each state seems to be passing a new law requiring paid sick time, and these need to be counted for hours of service under the Affordable Care Act. So it's something that employers really need to keep their eye on for the municipalities and states they're operating in, just to make sure that all these hours of services are being calculated properly. And the next thing is just having your look back and stability period, or if you're using the monthly measurement period, you want to have some documentation on what period you're actually using. And just to point out here, something that we are seeing frequently is people misclassifying variable hour employees or full-time employees as variable hour employees. The final regulations lay out 3 criteria that employers should look at when making this determination. And it's really important that employers get this correct, because if you're having a variable hour employee who's really a full-time employee and you're using this long measurement period, it could actually cause you to fail the 95% test, and this could lead to triggering the A penalty. And the same thing goes for employers that have independent contractors. If those are common law employees, in fact, they need to be offered coverage. So it's really important that you're classifying all your employees properly, and it's something that you should have professional advice on. And then I think the final thing is, go ahead.
I was going to say that's a great point, and I think, and I know we're giving you a lot of detail, and so this I hope is making you nervous, and I hope it also emphasizes the need to have an expert or an ACA attorney or someone to help you through this. And sorry, that was a sidebar, but it was a perfect time to make this point that I would say, Ryan, I guess you would disagree, or you would agree with me, because we've done a lot of these together, that there's not been a single client that I've worked with who we did not save them exceptional amounts of money. And I know this is the case with all of the ACA experts that are out there working. Employers are trying their best and thinking that they got this stuff right, but it's just so confusing, and there's just so many nuances that unless you're immersed in this stuff like Ryan and I are, or that many ACA experts are, there's no way you could possibly understand all of these little nuances.
Right. And then just to wrap up this point, I think it's really important that employers actually have plan documents going forward, which in the past they had not. I mean, we've had some clients say that they have a plan document and they submit a two pages to us saying this is our plan document. So that's going to be important because the audits are going to pick up in the future. And then finally, amending your employee handbooks. There are certain protections that can be inserted into the handbook, such as classifying employees with job categories that can protect employers from things such as ERISA litigation, and also it can make it more affordable for the employer because they can charge certain employees more. So that's a strategy that we've had several employers confront us about.
And then finally, we have already talked a little bit about proof that you hired an attorney or expert. That again goes to the good faith argument that, look, I really did help, and I had an attorney who even advised me that this was okay, and that goes a long way to document that. And then this last list, I'll go through quickly. Obviously, having proof that your employees accepted or declined coverage. This is critical because as much as we're hoping that healthcare.gov is fixed and that all of the exchanges keep proper documentation. At the end of the day, all you're going to have to go on to prove that someone who got a subsidy on the exchange or a tax credit and is triggering your penalty, all you're going to have to go on is proof that you offered the coverage to them and they declined it. So having this written, documented, and available, in my opinion, electronically, where it can be easily retrieved and shown for each plan year, is an absolute critical. It's an absolute must. I have all my clients write out their strategic plan, and some of them I've said, even if you've just got binders against the wall and you print out every discussion we have and write memos of what you're doing, that even is good. But if you can write out your whole strategic plan of what you did and why, that's better. Proof of all your correspondence with employees, all the letters that you send out, all the notices, and I do recommend putting things in writing. If the day that you offer coverage, put it in writing, explain what the coverage is, explain what their time frame is. If you can, even better, have them sign off that they got the notice. Evidence of HR practices, hiring policies, and proper classification. Ryan talked about it a little bit, but this is a huge planning area where I see a lot of employers that I work with saving lots and lots of money, and I see other ones who I think are going to get in lots and lots of trouble. If you've got your supervisors and your managers who are telling people, yeah, we're cutting your hours because of Obamacare, you're in trouble, and you need to make sure that your HR practices and your HR team and all your managers understand the law, understand what they can and can't say. If you've got a hiring policy of hiring part-time, make sure that you can establish a legitimate business purpose for doing so and that you're not doing it just to avoid benefits. The proper classification of employees is huge. And a lot of people don't even realize that. I've had in the last month, I had a very large employer call me and say that he was discharging 9.5% of each person's income. That's really scary, because I hope all of you by now know that you can't do that. You can have a classification of employee and charge 9.5% of the lowest wage worker in that category, but you can't just charge everyone their 9.5% for the same exact coverage. Then again, another one, clear documentation of all disciplinary action taken against employees. The reason for this is because there were whistleblower rules that were released, last year, I believe, that allow an employer to claim whistleblower status if they feel like they were discriminated against for getting a subsidy on the exchange. It's got a very low burden of proof, and this can be something like in the workers' comp world. I do a lot in workers' comp. When we see employees find if employee morale is low or they find some way that they can make a lot of money, it becomes like a cancer. When there's workers' comp claims in some of our fast food restaurants, sometimes there's multiple ones that follow suit. So having really clear records and understanding that your documentation of any policies of discipline are going to be very important, especially in the future. And then also the 7-year documentation policy, because now all of your documents are, in fact, tax records, because this goes as part of someone's permanent tax record. Ryan, do you have anything to add? We're about to wrap up here.
No, I think you hit all the points that I would have discussed. And I think your discussion of the HR practices, hiring policy, and proper classification is really important, because there is going to be a risk of litigation in this area. So making sure that your plan documents have proper job categories, and the plan document is clear on who's eligible and who's not eligible. While it might not save you from getting sued, it will do wonders for you in being able to defend any potential risk of litigation.
Yeah, great point. So that said, so let me just quickly summarize in our opinion, the most important thing that employers can do is, number 1, avoid the A penalty. Number 2, avoid the B penalty. Number 3, documentation. And obviously, we talked a little bit about how you avoid the A and B penalty. It's not by trying to be tricky or trying to beat the system. You want to do it at least in this first couple of years while things are shaking out and people really understand what's going to happen. You want to do it as safely as possible. You want to make sure that you're offering and this isn't for everybody. I mean, someone's going to do it differently, but I think it's a very solid strategy to offer a MEC plan across the board and then offer a bronze plan so that you satisfy both A and B penalty. And that said, here's our disclaimers. This is not a substitute for legal or tax advice in any way, shape, or form. We strongly recommend that you do get legal advice. And again, thank you to Freedom Care Benefits for sponsoring this program. And Freedom Care Benefits is a completely guaranteed ACA compliant solution that does take care of both the A and B penalty. So we strongly recommend that you look into that for your clients if you are still looking for a program like that. And Ryan, thank you so much for being with me today, and we will be back next week for our second part installment of our 6-week webinar series. Thank you very much for your time.
All right, it was great talking to you, Kaya.
You too. Bye-bye.